Hello and welcome to a brand new tutorial, Volume and Open Interest. Using volume and open interest as a tool for directional forecasting. In this tutorial, we will learn how to use volume and figures of open interest along with prices to understand the direction of overall market trend. In contents, we have introduction followed by volume, general rules for interpreting volume, interpretation of volume, volume confirms price patterns, volume precedes price, interpretation of open interest, 4 points of open interest, summary of everything we have learned. Finally, we will learn about blow-offs and selling climaxes and how volumes and open interest play an important role in identifying them. And then we will conclude our current tutorial. Let's go ahead. Introduction. Most technicians in financial markets use a multi-dimensional approach to market analysis by tracking moment of three set of figures, that is price, then comes volume, and then open interest. Volume analysis applies to all markets, whereas open interest analysis applies only to futures and options market. In this tutorial, we will learn about the role played by volume and open interest in forecasting process. Volume. Volume is the number of entities traded during the time period under study. Volume is usually plotted as a vertical bar at bottom of the chart under day's price action. Volume can be plotted on any time frame, whether it be an intraday data or a daily, weekly or monthly charts. So volume is the number of contracts or number of shares traded for the day. For example, if on any given day volume traded in a particular stock stands at 5 lakh, it means that 5 lakh shares have exchanged hands for the given day. 5 lakh shares were bought and sold by the participants for that given day. Similarly, if on any given day you see a volume figure at 1, it means 1 lakh quantity were bought and sold for that given day. So volume can be applied or volume can be plotted on any given set of data and any time frame, whether it be a daily chart or weekly chart, an hourly chart or a 1 minute chart. If you see a bank nifty chart for a 1 minute data, you will see volume being traded to be somewhere around 9,000 to 20,000 on 1 minute chart, which means for every given minute at least 9 to 20,000 shares were bought and sold, and this volume helps us understand the intensity of a price move. General rules for interpreting volume. Price is rising with increasing volume, then uptrend is strong. Point 1 says if prices are rising higher along with increasing volume means more and more shares are being exchanged or are being bought and sold, which means more participants are eager to trade in that stock. So if prices are rising with rising volume, with more participants flocking in, it means the upside price move is being supported by more and more people, which means it is a genuine upside move. If prices is rising with decreasing volume, then uptrend is weak. So if prices are rising but volume is decreasing, this indicates that not many people are interested in this price move. If people are not interested in upside rising prices, then certainly there is a reason to worry, because if prices were genuinely to rise up, why would anyone not be interested in buying that share? So if somebody is not interested, if more and more people are not interested in buying that share, something has to be wrong. So if price is rising with decreasing volume, then uptrend is weak. If price is falling with increasing volume, then downtrend is strong. This also stands to our reason. If prices are falling and more people want to sell their stocks and get out of that, it stands to the reason that something is definitely wrong with the stock. That is why prices are falling. And that is why there is rising volume with price fall. So if prices are falling with increasing volume, the downtrend is strong. If price is falling with decreasing volume, if price is falling and not many people are selling the stock away, they want to hold, it means that downside is weak. Maybe you'll see a change in price move. So these are four basic yet very important rules for interpreting volume. These rules will also be applied to open interest, but for now we'll concentrate on volume. So rule number one, prices rising and volume rising, trend strong. Rule number two, prices rising, volume falling, trend weak. Rule number three, prices falling, volume rising, trend strong. Rule number four, prices falling, volume falling, trend weak. Alright, let's go ahead. This is our first chart. You can see every time prices make a new high, volume starts to gradually increase. Every time prices pull back, there is a decrease in volume. Prices rise, volume increase, pull back, volume decrease, rise, increase. So increase in volume is supported every every time there is a new high made in price. Volume supports the new high, which means more and more quantities are being bought at new high level. So volume support this price move, hence trend is strong. Next, you can see here prices are rising, volume increasing, volume prices pull back, volume decrease, prices rise, volume increase, pull back, decrease, rise, but volume suddenly has dried up, which means new high made in the prices are not supported by new increase in volume. This certainly stands to our reason that something is wrong with this stock, or people are no more interested to buy this stock at new high levels. So, from this point, we should be alert that the uptrend A has weakened. It might reverse or it might start consolidating. Our next chart is chart of a strong downtrend. This also follows the same rule. Every time prices make a new low, it is supported by increase in volume. And every time there is a pullback, volume decreases, shortens itself. So you can see every time prices make a new high, there is an increase in volume. More and more stocks are being sold at new low, which means the trend is strong. Similarly, at some point, new low is not supported by increasing volume, which certainly which can be given a benefit of doubt that this trend has changed its momentum and now it is weakening. Interpretation of volume. The level of volume measures intensity or urgency behind the price move. Heavier volume reflects higher intensity of pressure. By monitoring the level of volume along with price action, one is better able to gauge the buying or selling pressure behind market moves. This information can be used to confirm price movement or warn that price movement is not to be trusted. So a new breakout to a new high accompanied by a strong volume definitely suggests us that prices are rising on increased interest for that new high level maintained in the price. Following is a daily chart. You can see prices are in an uptrend, upside moving wave-like pattern indicative of an uptrend, and every time prices make a new high, prices are supported by higher volumes. See here, every time prices made a new high, new highs were made in volume too. So this is a very good example of a strong uptrend where strong uptrend in prices are supported by increasing volume every time there is a new high, and every time there is a pullback, volume simply contracts itself. You can see here, pullback, volume contracted, prices made new high, went towards new high, volume increased, price started pulling back, volume contracted themselves. This clearly suggests that people are not interested to sell out of this stock. Rather, they want to hold this stock for new high levels. Every time prices made a new high, new volumes, new fresh buying came into the stock which pushed it to new higher levels. To state more clearly, volume must increase in direction of main trend and contract on pullbacks. As long as volume is showing this pattern in a trend, it is safe to assume the trend would continue. If any kind of divergence is seen in price move and volume pattern, then an analyst must get alert about current price trend. Volume confirming price patterns. Head and shoulder pattern prices into new high during the formation of head on light volume with heavier activity on subsequent decline to neckline. So, volume can be used to interpret various chart patterns like head and shoulder patterns, double and triple tops, continuation patterns, a rectangle, a flag, a pennant, etc. For example, in a head and shoulder pattern, when prices make first shoulder is usually seen to be made on higher volumes, followed by a new high made on head, which is made on lighter volumes, which is again followed by the next shoulder that is lower than the head, is made on significantly lower volume. But what important point to be noted is every time prices pull back to the neckline, the pullback is usually made on higher volumes, and then a breakout below the neckline occurs on extremely high volume. If there is any pullback, then such pullback is made on lighter volumes. Similarly, double and triple tops are made on lighter volume, with each successive peak followed by heavy downside activity. So in double and triple tops, every peak is made on light volumes, whereas volume increases once prices change their direction towards the downside. Let's learn how volume behaves in continuation patterns like triangle, flags, and rectangles. A gradual drop in volume is seen while formation of pattern. While these continuation patterns are being formed, there is a gradual drop in volume, which is followed by heavy trading activity. A breakout happens in real time. In a downtrend, the volume should be heavier during down moves and lighter on bounces. As long as the pattern continues, selling pressure is greater than buying pressure, and downtrend should continue. It's only when this pattern begins to change that the analyst should look for signs of bottom formation in a downtrend. Following is a daily chart of Amrutanjan Industries, and you can see the markings on bar chart which suggest us that prices just broke out from a triangle formation. Now let's take a look at the volume. In first leg of the new high move, prices made new high on heavier volume. Subsequently, prices declined and volume simply contracted here and there. Within the decline, here and there was a high volume price range, but nothing significant. Prices traded in a range to form a triangle pattern, and then prices broke above the trend line. You can see breakout above trend line was followed by new high in volume. Rise of volume was extremely substantial as followed to the volume that was being traded in the range movement of prices. So once prices broke out to a new high, volume increased substantially, suggesting that new high is being supported by more participation in the market. And you can see prices went to make a new high. But here you can see this new high was made on lighter volume. What does this suggest? This new high may not sustain itself as more participation is not seen in the given stock. So this is where you must look to get out. This is how volume helps us to understand the strength of a price move. You can see here new high was made on heavier volume, followed by contraction and contraction of volume. Again a new high and new heavier volume, and prices continued to go higher. Again a new high was made, but on extremely light volume. This is a reason for concern. This suggests that prices may not sustain itself on these levels, which prices did, and then they pulled back and started consolidating. Our next chart is also a chart of Amtech Auto. It's a daily chart, and as of the first arrow, you can see prices made new high on increased volume. Here prices tried to go to newer highs but failed and came down. Now this downside move was supported by increased volume. If prices are rising higher, every time there is a downward move, volume must contract itself, which would tell us that people are still not ready to sell out of this stock. But here, prices came down on heavier volume, definitely telling us something is wrong with this stock, which was confirmed by this top as prices went to test new high, but volume simply did not was simply not interested, clearly telling us people are not interested to support this upside price move for new highs, which was again confirmed by this top where volume simply did not increase. There was no substantial increase in volume, and then prices started moving downwards, and this downward move was supported by a slight increase in volume. You can see here, compare this consolidation with this downward move in terms of volume. When consolidation was taking place, volume had simply dried up, And when volume prices started moving downside, you can see volume increased slightly to the upper node. So interpretation of volume is extremely important to understand the strength of price move, which clearly depicted itself in this example of Amtech Auto, where prices made new high followed by new volume. Then prices came down on heavy volume, which was a reason for worry, which was confirmed by these two tops that told us there is no increase in volume. No, people are not interested, or people do not think that prices will rise to make new high, which was confirmed by this downside move. Volume precedes price. By monitoring the price and volume together, we are using two different tools to measure same thing: momentum pressure. The fact that prices are trending higher tells that there's more buying than selling pressure. So it is reasonable that greater volume should take place in direction of trend. Many a times it is observed that a loss of upside pressure in an uptrend or downside pressure in a downtrend shows up in volume before it is manifested in reversal of price trend. Amtech Auto was a perfect example for the fact that volume did precede price. You can see here prices made new high volume, but then volume simply contracted even when prices continued to trade sideways, definitely telling us that upside momentum has dried up in volume. Volume is not, people are not looking that prices might go to new high. And later on, the warning of volume was confirmed by downside price move, which went to as low as 150. Even in Amrutanjan daily chart, same thing happened. This new high was not supported by increased volume. You can see here, this new high was made by volume to the length of 3 million, whereas this new high was made at the highest volume at 1 million. That is almost 35% lesser than the volume made at previous highs. Lesser volume definitely suggests us not many people think that prices will continue to sustain themselves at these levels. Our next example, daily chart of Reliance Power. You can see here prices made new high on increasing volume, where highest volume was made to the length of 40 million. Then prices pulled back and continued to make new highs, but volume decreased, warning us that people do not think new high will continue to sustain itself. Can see here highest volume made at this point was 40 million, whereas here it was somewhere around 25 million, almost a 30% decrease in volume at newer high levels. So volume precedes price in warning us that new price levels may or may not sustain themselves. Interpretation of open interest. But before going ahead and learning how to interpret open interest, let me give an introduction to open interest. What exactly does open interest means? The word itself is self-explanatory. Open interest, which means how many people are interested in taking a position in that stock or in that future contract. Open interest applies to futures and options market. Open interest is not applied to stocks. Open interest is number of quantity held by individuals and any kind of traders. What really open interest means is the number of quantity held by people in that future contract. So open interest means standing positions in that given future contract. This standing position could be short position or a long position. We don't know that, but open interest figures definitely helps us in understanding what is going on with that price move or what is the strength of that price move. Open interest will definitely help us understand whether the price move is strong or weak, whether the price move is being undertaken by strong hands or whether the price move is simply getting out or bailing out of weak hands. So rules for interpreting open interest are similar to that of volume but require additional explanation. When prices are advancing in an uptrend and total open interest increasing, new money is flowing into market, reflecting aggressive buying and is considered a bullish sign. So a prices is moving in a given market and open interest is increasing. For example, total outstanding trade was 10 lakh. When prices made new high, total outstanding trade increased to 15 lakh. What does that mean? It means people have either A bought new shares on newer high or B people have sold more shares on newer highs. Okay, since prices are making new high, it is impossible that new shorts will be made on newer highs, as most experienced traders will support or will stay on the right side of the market, which means if prices are making new high, they will definitely go ahead and buy more stocks. So when prices are advancing in an uptrend and total open interest increases, new money is flowing in. More and more traders are buying into the stock or creating new positions. Hence, open interest is increasing, which is a bullish sign and reflects aggressive buying. Point number two: if volume, if price are rising and open interest decline, the rally is being caused primarily by short coverings. Holders of losing short positions being forced to cover those positions, which means money is flowing out of market. This action is considered bearish because uptrend will run out of steam once necessary short covering is completed. In our second point, if prices made new high but open interest decreased, let's say open interest was standing at 10 lakh when prices made new high, open interest decreased to 8 lakhs. So the 2 lakh shares that decreased suggest us that the short positions, people who had sold into the future stock, the future contract, were stopped out at new highs. That new high was their stop loss level, and when new high was triggered, they were stopped out or forced to cover or close their standing positions. Hence, interest decreased from 10 lakh to 8 lakh. So, if prices make new high but open interest decreases, this suggests us that the new higher levels or the new rally was triggered by losers trying to scramble their positions, trying to bail themselves out of these newer high in price levels. Hence, new high was not supported by new increasing number of open interest, whereas new high was supported by people who were trying to bail themselves out of their current position. So this new high will definitely not sustain and it will reverse. Hence, new high on decreased open interest is considered bearish Third point suggests when prices are in downtrend and open interest rising, analyst knows new money is flowing into market, reflecting aggressive short selling. So this is important point. When prices are in a downtrend, prices are falling and open interest is increasing. Every time prices make a new high, new set of short selling comes. More and more people are selling into the future contract, or more and more people are creating the short positions in the contract. This tells us that this downside move is strong and will continue to go downside. Our fourth point, but if downside move is not supported by increasing open interest, but this downside move is supported by decreasing open interest, this is a situation to worry about. This downside move is being created by people who are covering their buy positions. This new low and this downside move after new low is being fueled by people who want to cover or close their positions, people who are desperate to close their positions because they were stopped out. The stop loss was triggered. So if a downside move is supported by decreasing open interest is contracting or decreasing. This definitely tells us this downside move is fueled by people who want to close their position, who don't want to create new position because they think prices will continue to go downwards. This downside move was fueled by people who want to close their position and get out of the market because they were wrong. So if a downside move is supported by decreasing open interest, this suggests us that this downside move is not reliable and it might not continue to go downward. So, shortcut to understanding interpretation of open interest. First, rising open interest in an uptrend, rising open interest in a rising price move, it is considered bullish. Declining open interest in an uptrend, falling open interest in a rising move, it is considered bearish. Rising open interest in a downtrend, more and more open interest being created with prices falling, it is considered bearish. And declining open interest in a downtrend, falling open interest while prices are making new high is considered bullish, or prices will fail to make new high prices will fail to make new low consistently. Other important situations for open interest interpretation: towards the end of a major market move where open interest has been increasing throughout the price trend, a leveling off or decline in open interest is often an early warning of a change in trend. So, towards the end of major market move, open interest is increasing throughout the trend. If suddenly you see a leveling off of open interest, which means prices are continue to make new high but open interest is not increasing, or prices make new high but open interest starts decreasing, is an which means people now are suspicious of this newer highs and people want to book profits at these higher levels. So a leveling off of open interest or a declining open interest while prices continue to make new high suggests us that smart money is booking profit and getting out of the market and getting out of their positions. So it is an early warning of change in price trend. A high open interest figure at market tops can be considered bearish if price drop is very sudden. This is a extremely important point. High open interest on market tops. Let's say there is a market top, prices have made an all-time high and open interest is super great, is super big. Alright, and for some unknown reason, prices drop suddenly. There is a flash trade or an important government news. Prices drop is extremely sudden, whereas open interest is extremely huge. What does this make? There will definitely be some kind of panic in people who are holding position in that future contract. And since there is a sudden huge price drop, they will get scared or worried, or they may not want to lose more profit from their current position, and they will look to get out of their current position. What does this make? Huge open interest means a lot of traders will look to book profits or will look to preserve their profit, their hard earned profit. As a result, it will give way to a chained selling, a gradual selling process. Hence, a high open interest figure at market tops can be considered bearish if price drop is very sudden. If price drop is very sudden, a lot of traders will come flocking to get out of their trades, to sell into their positions and close their positions, which means prices will start selling down. This means that all of the new longs established near the end of the uptrend now have losing positions. Their forced liquidation will keep prices under pressure until open interest has declined sufficiently. Hence, high open interest figure at market tops is considered bearish if price drop is very sudden. If open interest builds up noticeably during a sideways consolidation or a horizontal trading range, the ensuing price move intensify once breakout occurs. Let's say there is a sideways pattern being formed. Prices are not making new high, prices are neither making new low, but still open interest keeps on growing, which means a lot of traders are anticipating price breakout in a particular direction and they are creating their position. But so because no one is sure which direction the trend breakout will take place, a lot of traders are anticipating a breakout. But increasing open interest tells us that a lot of traders are taking position in anticipation of breakout. Once that breakout does occur, a lot of traders are going to get caught on the wrong side of the market. So, if open interest builds up noticeably during a sideways consolidation or horizontal trading range, ensuing price move intensifies once breakout occurs. So the breakout price move intensifies because people who got caught on the wrong side will run to cover their losing positions. Hence, upside or downside price move will intensify. Increase in open interest at the completion of any price pattern is viewed as added confirmation of a reliable trend signal. For example, the breakout of neckline of head and shoulder bottom is more convincing if breakout occurs on increasing open interest along with heavier volume. So, if a breakout occurs out of a given pattern, this breakout is supported by 1. Heavy volume and 2. Increasing open interest. This is a very good sign that the breakout is reliable and will continue in its newfound direction. So let's summarize the important points that we learned in volume and open interest. Point number one, volume is used in any market, whereas open interest is only used in futures market. Only total volume and open interest are used in futures market. Increasing volume and open interest suggests that price trend may be increasing or price trend will continue in its given direction. Declining volume and open interest suggest that price may be changing. Volume precedes price. Changes in buying or selling pressure are often detected in volume before price. Any volume-based indicator can be used more accurately to measure the direction of volume pressure. Point number 7. Within an uptrend, a sudden leveling off or decline in open interest often warns of a change in trend. This applies to futures only. Point number 8. Very high open interest at market tops is dangerous and can intensify downside pressure. Number 9. A build-up in open interest during consolidation period intensifies ensuing breakout. Increase in volume and open interest helps confirm the resolution of price pattern or any other significant pattern developments that signal the beginning of a new trend. Blow-offs and selling climaxes. These are two market conditions where volume and open interest will help us to a greater length in understanding price moves. Blow-offs occur at major market tops and selling climaxes at major market bottoms. In futures, blow-offs are often accompanied by drop in open interest during final rally. In case of a blow-off at market tops, prices suddenly begin to rally sharply after a long advance and then peaks abruptly. In a selling climax, prices suddenly drop sharply on heavy trading activity and rebound as quickly. So, in blow-offs, after a gradual upside move in prices suddenly expand themselves on extremely high volume. If it's a future market and you take a look at open interest, these upside price move or upside jerk in price move is not supported by increasing open interest. Open interest falls significantly on these higher levels and then prices change their direction and fall abruptly. Similarly is the case with selling climaxes. In selling climaxes, a gradual downside move is intensified and prices drop significantly in a short period of time. This price drop is supported by extreme increase in traded volume. But if you take a look at open interest, if it's a future market and you have open interest figures in front of you, then you could see this significant price drop is not supported by significant increase in open interest, whereas this price drop is supported by a decrease in open interest, which means a lot of traders have covered their profitable positions or booked profits. So blow-offs and selling climaxes occur at major market tops and bottoms respectively. Blow-offs are for major market tops, selling climaxes are for major market bottoms. In both conditions, volume are supported by high figures, but open interest decrease significantly. Following is a daily chart, and you can see the place where white arrow is marked. Prices started moving up from Feb till June. Prices rose from the level of 16 to make a new high at the level of 36. This new high was accompanied by an extremely increase in volume. You can see volume almost rose above 1.5 lakh, or if you compare this volume bar with these previous ones, it is almost 10 times greater than these. So, an extremely surge in price accompanied by an extremely increase in volume, and then prices simply starts dropping with contracting volume, and then prices start moving sideways. So this was a clear example of final stage of rally displaying a blow off. Our next example is a daily chart of SGJHL, and where this line is marked, you can see before that prices were gradually falling down on increasing volume, indicative of a downtrend, a progressive downtrend. But then prices started dropping suddenly. You can see here prices started dropping more spontaneously at greater speed, accompanied by increased in volume. Even though this single bar is larger than any one of these around here, but this single bar, but if you take a look at the bunch of these volume, it is still lesser than the volume that took place in this region. So prices were falling down extremely on increasing volume, and then prices came down falling to make a new low at this region, and you can see volume is not greater than volume that took place here, suggesting that a blow off took place in this region, and this downside selling pressure was not as strong as this one. As a result from this data, we could be safe to assume that downside move has completed and prices will either consolidate or start moving upside. So you can see prices started recovering themselves gradually. So blow off occur at major market tops and selling climax occur at major market bottoms. In futures, blow offs are accompanied by drop in open interest, and selling climax is also accompanied by drop in open interest. In case of blow-offs, at market tops, prices suddenly begin to rally sharply after a long advance and then peak abruptly. As we saw here, prices peaked abruptly and then came down falling straight away. In case of selling climax, prices suddenly drop sharply on heavy trading activity and rebound as quickly. So happened here, prices came down falling and then they rebound as quickly. Open interest in options. Understanding open interest in options is very important to find support and resistance zones for any future contract. It is often believed that only large institutions make money in options market, and most large institutions sell options to keep premium. So if any option level finds large open interest, whether it be a put option or a call option, then that price level will definitely act as strong support or resistance zone. For example, if Nifty is trading at 8,000 level and upon studying open interest in options, we see that there is a large open interest at 8,300 call and a large number of open interest at 7,600 put. Then we understand the following. Large institutions have shorted large quantity at 8,300 call because they think market will not cross 8,300 level for that given expiry month. Second, large institutions have shorted large quantity at 7,600 put because they think that market will not cross 7,600 levels for that given expiry month. So understanding open interest in options level can help us identify support and resistance zones for that future contract. Put call ratio. Put call ratio is built using options volume figures. The idea behind building put-call ratio is that if a market looks bullish, then heavy volume will take place in call, and to the contrary, if heavier volume takes place in put, then it is considered as a bearish market. So, a high put-call ratio means heavy volume being done in put options and bearish sentiment. So, put-call ratio means total volume made in put divided by total volume done in call. Let's say total volume for put is 15,000 and total volume for call is somewhere around 5,000. So that brings put call ratio to 15,000 divided by 5,000 equal to 3:1. For every one call option traded, there are 3 put options being traded, which means more people think that market is going downside, hence they are participating in put. Now, why are people participating in put options and not in call options? If you have knowledge of options, you will know that a put option has unlimited downside potential but limited upside potential. If market goes down, put has unlimited upside potential. Put will make more money if market goes down, and put will lose limited money, that is its premium, if market goes up. Whereas call option has unlimited upside towards market. If market is going upside, call has unlimited upside. If market is going down, call has limited downside. So if more volume is made in put, people are looking for unlimited gain in put, which means people think market is going down. Whereas if there was a negative put call ratio, this would definitely tell us that people think market will go upside and hence they are participating more in call. So a put call ratio helps us understand direction of market. A negatively high put call ratio means heavy volume being done in call options and a bullish sentiment. For example, total volume for put stands at 10,000 and total volume for call stands at 40,000. What does this say? For every one put traded, there were 4 calls traded today. This definitely tells us people participation was more in call, which means people think prices are going to go upside or the uptrend will continue. So put call ratio also helps us identify or understand the strength of a given price move or strength of a given price trend. That brings us to conclusion. Our coverage of volume and open interest. Volume analysis is used in all financial market, futures, options and stocks, whereas open interest applies to futures and options. Analysis of volume and open interest can be applied on any time frame, whether it be daily, weekly or an intraday time frame. So I hope you have learned importance of volume and open interest in identifying the strength of a price move from this tutorial.